Every trader watches the order book. They see the bids and the asks, the flickering numbers of the level 2 screen, believing they are witnessing the raw, unfiltered formation of price. They are wrong. They are watching a performance, a carefully curated shadow play designed to distract them from a chilling fact. In the year 2023, nearly 45% of all U.S. stock volume was executed in complete, deafening silence. This is the shadow ledger, an invisible architecture of private exchanges known as dark pools, where trillions of dollars in transactions occur entirely off the public record. The common narrative suggests these venues exist for a benign purpose: to allow large institutions to trade massive blocks of shares without causing significant price impact. This is a dangerously incomplete truth. It is the public relations story, not the operational reality. The lab's analysis reveals their function is not merely passive, but predatory. Dark pools are not just a place to hide. They are a place to hunt. They provide a structural advantage, an informational asymmetry so profound it allows sophisticated players to systematically exploit the emotional and reactive nature of the retail trading public. To comprehend this, one must first discard the notion of a single, unified market. There are two markets: the lit market, which you see on your charts, and the dark market, which sees you. The lit market is a theater of emotion, driven by visible order flow, news events, and technical analysis patterns. The dark market is a cold, silent world of pure information, where the true institutional intent is formed and executed long before it ever registers on a public price feed. The price you see is not the price. It is the echo of a transaction that has already happened. Consider a simple support level on a chart. A retail trader sees the price bounce multiple times and perceives strength. They see a floor. They place buy orders, confident in the collective agreement of the market. But what if that floor is not a floor at all? What if it is a fabrication, a carefully painted level, designed for the sole purpose of accumulating retail liquidity before the price is allowed to collapse? This is the primary weapon of the shadow ledger: the ability to absorb immense buying or selling pressure without ever appearing on the public order book. An institution may wish to sell 1 million shares of a stock at $100. If they dump this order on the lit market, the price would plummet as supply overwhelms visible demand. Panic would ensue. Their average fill price would be catastrophic. Instead, they route the sell order to a dark pool. Simultaneously, their algorithms begin to probe the lit markets. They place small, visible buy orders at the $100 level, defending it just enough to create the illusion of support. They allow the price to dip to $99.90, then buy it back to $100, reinforcing the pattern. Retail algorithms and discretionary traders detect this support. They begin to place their own buy orders, adding to the bids on the level 2 screen. They are, in effect, volunteering to be the exit liquidity for the very institution that is luring them in. For every share a retail trader buys at $100 on the lit exchange, the institution silently sells a share at $100 inside the dark pool. The net effect on the public price is zero, yet the transfer of shares and risk is total. But the real power of this mechanism is hidden in a parameter most traders have never even heard of. It's not just about matching trades in the dark. It's about controlling who you trade with and what information they are allowed to see. To understand why this strategy traps even experienced traders 90% of the time, we must first examine the flaw in their core logic: the belief that volume confirms price. The institution is not merely selling, it is orchestrating a narrative on the chart. Each small defensive buy order they place on the lit market is a word in a sentence, designed to tell a story of strength. The volume signature looks healthy. The price action appears constructive, but the ledger is imbalanced. The book a retail trader sees is fiction. The shadow ledger holds the truth. Once enough of their 1 million share sell order has been filled, once the retail buying liquidity at the manufactured support level begins to dry up, the performance is over. The institutional algorithms withdraw their small, defensive buy orders. The floor that seems so solid simply vanishes from the order book in a millisecond. What happens next is an engineered collapse. The price slices through the $100 level as if it were never there. It triggers a cascade of stop-loss orders from the very traders who bought at the support. These stop-loss orders are, by definition, market sell orders. They add rocket fuel to the downward move, pushing the price down to $98, then $97. The institution has not only exited its position at a perfect price, it has catalyzed the very momentum that profits its new, unrevealed short position. This is not a rare occurrence. This is the daily, hourly, and minute-by-minute business of the modern market structure. It is a game of information asymmetry, where retail traders are playing poker but are only allowed to see 2 of their cards, while the institution sees the entire deck. The patterns they trust are the very bars of their cage. To navigate this environment, one must learn to read the invisible signals. It requires a fundamental shift from analyzing what is present on the chart to analyzing what is suspiciously absent. The market's silence often speaks louder than its noise. We must look for the ghosts in the machine, the evidence of large transactions that were deliberately kept out of sight. Sophisticated players don't just hide in the dark. They weaponize it. They use the information gap between the private ledger and the public chart to manufacture consent, to paint a technical picture that justifies and conceals their true actions. To understand this deeper level of manipulation, we must first dissect the anatomy of what is known as a ghost print. This is the faint signature left behind when a dark transaction is forced, by regulation, to report to the public tape. This reported trade contains clues. It is often reported with a delay, sometimes milliseconds, sometimes longer. Its price may not even match the current bid or ask on the lit market. Most algorithms, and nearly all human traders, filter this data out as noise or a bad print. But it isn't noise. It is a message. It is a glimpse into the shadow ledger. The key to seeing the trap before it springs is not in the price action itself, but in the subtle discrepancies between the volume you see on the chart and the volume that is secretly being transacted. But the institutions know this, and they have a way of muddying the waters even further. A technique so subtle, it's almost impossible to detect without the right tools. A technique known as internalization. What if the entity you are trading against is your own broker? This is the apex predator of information asymmetry. When a large broker-dealer internalizes order flow, they can legally match client buy orders with client sell orders within their own systems. They become the exchange. They see every card, every bet, and every panicked click before it ever has a chance to influence the public price. The transaction never has to touch a lit market. It doesn't even need to enter a dark pool. But here is where the manipulation reaches a truly psychological level. What if the very ghost prints we thought were clues are actually part of the performance? What if an institution intentionally reports a large, delayed trade, knowing that savvy traders are looking for it? They can paint the tape with a fiction designed to be decoded, a breadcrumb trail leading you precisely where they want you to go. How do you hunt a ghost that knows you're watching? How can you trust the data when the data itself is a weapon? This shifts the battle from the charts into the realm of game theory. To survive, it's not enough to understand the mechanics of hidden orders. You must understand the intent behind the information that is allowed to become visible. But what if the deception runs even deeper than the data itself? What if the very software you use, the charting package you trust, is designed not to show you the battlefield, but to paint you a picture of it? This is the final illusion, the belief that you are playing their game. The rigged software, the fabricated prints, the internalized orders, they are not the battlefield. They are a calculated distraction, a grand piece of theater designed to make you feel powerless, to make you react emotionally, to make you chase ghosts and follow false trails until your capital is exhausted. The real game is not played on the screen. It is played in the mind. The ultimate edge is not a faster algorithm or a secret data feed. It is the ability to achieve absolute mental clarity amidst a storm of deception. It is the discipline to discard the map they hand you and to navigate by first principles. To stop asking, what is the price doing? And to start asking, what action are they trying to induce? You escape the trap not by outrunning it, but by understanding its design, by deconstructing the performance. This requires a new set of tools, not for charting, but for thinking. Tools of logic, of game theory, of inferential reasoning. It means building your own model of the market from the ground up, based on the unchangeable truths of liquidity, incentive, and human psychology. You cannot win a rigged game, so you must stop playing it. You must create your own, a game where their every move, every feint, every piece of misinformation becomes a data point in your own, more accurate model. Their deception becomes your clarity. Their noise becomes your signal. They are no longer the predator, and you are no longer the prey. You become the analyst observing the ecosystem. The market is a construct. The data is a narrative. The chart is a story. The only way to win is to learn how to read the author's intent. The tools for this are not for sale. They must be forged in the fire of critical thought and relentless analysis. That is the work we do here. Welcome to the lab. Subscribe to trade_logic_lab, and let's begin the real work.